So many of you have asked about my opinion on Disney stock, as Disney stock has fallen so much from over $185 a share to around $95 a share right now. Complete bloodbath for Disney stock. Did it actually get cheaper, or is it still expensive? Is it time to buy now, or maybe you should wait for a better price? That's what I'm really going to cover in today's video. It's not gonna be a deep analysis with all kind of stories. It's more around focusing on numbers and kind of assessing the probability to see if Disney is a deal right now, or is it maybe a little bit expensive and we should wait for a better price. The company makes money in two main segments. The first one is Disney Media and Entertainment Distribution, and this one saw 9% growth, quarter on year. And Disney Parks Experience and Products, which saw over 100% growth. So the total revenue growth was around 30%. But of course, there is a catch to this growth. The first one is most of it came from Disney Parks Experience, and a lot of those parks were closed last year or the year before. So this is also part of the recovery, meaning Disney didn't really grow 100% in those things. It didn't just double its revenue. It's just catching up to the revenues that it has lost, years and years ago whenever those parks were closed. And now it's recently reopening in China, so those type of growth is gonna continue for Disney parks. But this is not any organic growth or anything for, something new for Disney. This is growth they had in the past, and they're trying to regain what they had. The second one, which is interesting to most people, is the Disney Media and Entertainment, which includes Disney Plus. And this grew over 9%, year over year, and it's pretty amazing. But as you may know, the direct-to-consumer segment around Disney Plus, ESPN, and Hulu is actually not profitable. And the losses more than doubled, quarter over quarter, and year over year, they also doubled around 96%. So they lost 96% more on those type of products, and it's really, really not good. And it's of course a big risk with the stocks. They are doing a lot of things in this, many people call it the spending wars. They're trying to compete with something like HBO Max, with something like Netflix, and many other things. Now of course Disney has its own name and it has its own niche, and it's recognized all around the world, so it's having an easier time, but it's spending a lot of money and it's losing a lot of money, and those losses are not getting better, they're actually getting worse, which is something I don't really like to see. But of course the CEO is promising that Disney Plus should be turning profitable in fiscal 2024, so it's a long way ahead. But again, in terms of the trends that I'm saying, the losses are not getting smaller, they're actually getting bigger. And I'm gonna monitor that over the coming quarter to see if those losses continue to get larger or they actually get smaller. If they were getting smaller, I would personally believe the CEO in kind of saying that that is gonna turn profitable in 2024. But again, I'm not really seeing it in terms of the data. But again, it may also happen. So this is a big risk with Disney. Disney is an amazing company, but Disney Plus, they're trying to win the streaming war by spending a lot of money, and they may turn profitable and they may not, especially when the consumer has many other choices like, Paramount, which have, Nickelodeon, things for kids, and something like HBO Max or Warner Brothers Discovery, which also has pretty amazing content for kids, for parents, for sports, and many other things. So this area is getting very, very competitive. But Disney may not be affected as much as others, mainly because it's diversified in terms of revenue. It has the theme parks, it has the movies, it has the direct-to-consumer, it has many things it can make money on. So let me point out some of the risks before I go to the valuation and my kind of upside potential target on Disney stock. The first risk, and again, many of you actually ignore this is the whole thing around the macro environment with Disney. Disney now is making amazing earnings, but the macro environment, the way things are going in terms of the consumer sentiment, which is the lowest in the history of the entire survey, less than 50, I believe around 50 to 51. And along with savings going down, credits going up, many people are not going to be able to afford to go to Disney parks, which where the growth is coming in. Maybe they're not going to be able to afford to have Disney Plus. They're going to choose something cheaper like Paramount Plus for $4 or $5 a month, or maybe something else. So those earnings are going to get challenged in terms of the macro environment. That doesn't mean that Disney is not going to do well or it's not going to grow revenue, but there's always going to be something pulling it down, which is consumer having less and less money to spend on discretionary spending, like, the amazing expensive Disney parks and many other ways, Disney makes money on. Many people are gonna push this trip maybe to another year or the year after, mainly because they don't have the money to do it. So this is a big risk with Disney. Again, the second big risk is the whole thing that happened with them, with the governor of Florida, the whole thing around the special district. This one, I honestly don't really know how it's going to play out. It may be good for Disney, but it's most likely going to be bad for Disney. Plus, the CEO, he's really getting involved in a lot of things that doesn't really belong to the company, if you know what I mean. I normally like CEOs who are under the radar. They just stick to their own business, they run the company, and they just stay quiet and leave, politics aside and everything aside, and just focus on running the company. But the way things Disney are doing that type of stuff, they may come back to haunt them. For example, I'm just giving an example. Let's assume the Republicans win in 2022 and in 2024, and all of them, they kind of talk on the news to cancel their Disney membership. And many people are actually canceling their Disney Plus membership, and they are not going to the annual passes for the parks in Florida, mainly because of this whole thing. So those are customers that were lost just because the CEO decided to get involved in something that doesn't really belong with the company's business. And it's gonna be affected by it. And again, you can see it on what the CEO is doing, but this is what he did, and this is something you have to pay attention to in terms of the management with Disney. Now let's take a quick look at the valuation, basically the enterprise value to EBITDA, and it has come down a lot over the year. It was around 56 over the past year, and now it's sitting around 21. And you may think that Disney is the best deal in the world, but it's actually not. If you look at the history of Disney, now it's trading at 21 enterprise value to EBITDA, but in 2019, late 2019, it was around 10, and it's always been between 10 and 11. So why is it trading double? Mainly because they introduced Disney Plus. And Disney Plus is not profitable. And it may never actually be profitable. Maybe this streaming war goes on forever. Now Disney Plus is very important. But do you believe that Disney deserves double the valuation that it had in 2019 just because of Disney Plus or a couple of other things they acquired? To me, I don't really think so. I would best put Disney at a, not at a 10 enterprise value to EBITDA, maybe 12 to 15, a little bit of a premium, but almost double the valuation that it had in 2019, mainly because of Disney Plus and many other things the company did. I don't personally think it's worth it. So in terms of the valuation, it's still a little bit expensive. It's not the best value in the world, and many people like Warren Buffett actually preferred buying something like Paramount over buying Disney stock in terms of to get some exposure not just to the linear business, but to also the direct-to-consumer with Paramount Plus. Now let's look at the valuation model to determine the upside potential on Disney stock to determine if it's a buy right now or if it's something maybe we should wait on. So this is my valuation model on Disney. Now it's making around $67 billion in revenue. I chose a 10% growth over the next 5 years with a challenging environment in terms of economics and consumer spending, and in terms of the growth of Disney Plus, I accounted this in the revenue. Without Disney Plus, I believe Disney could grow between 6 to 8%, but I put in 10% because I believe it can actually do it because of Disney Plus and all of the other direct-to-consumer stuff. So 10% is pretty fair. You get around $108 billion in 2026 in terms of revenue after 5 years. Now their net income margin is around 8.5%. I chose an 11% net income margin, a higher than now, mainly to assume that Disney Plus actually becomes profitable, a profit machine for Disney, as it's direct to consumer. It should increase their net income margin, as their theme parks are lower kind of margins than Disney Plus. So this is why I chose a premium for Disney's net income margin with a PE ratio of 25. And even though I think it's rich, it's mainly because of the brand name Disney Plus. Disney is recognized all around the world. A lot of kids love Disney, and this type of things, just like Coca-Cola, always deserves a premium. So a 25 PE on Disney would give you an upside of 68% over the next 5 years, or only 11% compounded every single year for the next 5 years. Now, in order to double your money with something like Disney, we can try, for example, a 30 PE just to determine like that. So if you had a 30 PE, this way you could maybe double your money on Disney. But again, I would not be betting on Disney trading at a 30 PE 5 years from now, especially as the growth is going to be probably under 5% growth, if not lower than 5% growth, as those direct-to-consumer, which are pushing all to revenue growth, actually becomes profitable, and you have many of them around the world. So this growth is not gonna stay high. So again, my fair value is 25 PE, but if you're actually able to get a 30 PE 5 years from now, which is very unlikely, you could maybe double your money with Disney. But I would personally not bet on it, especially as now the market has fallen down and you have many more deals to buy. If I had to choose to bet on something in terms of streaming, I would buy something pretty cheap like maybe Paramount or Warner Bros. Discovery, as they have many hidden assets that can be potential acquisition by big players like Disney or Netflix. So personally, I would not be buying Disney right now. It's sitting at $95 a share, maybe $70 to $75 would be more worth the risk reward for me. But now I'm not touching Disney, I'm keeping it on my watch list. So now you watch this video and you could do your own analysis on Disney and determine if it's a buy for you or not. So I hope you enjoyed this video, and if you liked it, please press the like button and maybe consider subscribing. So I hope to see you in another video.